Cash feels safe. It's in your wallet, your savings account, maybe even under the mattress, but in today's economy, cash is quietly losing value every day. Inflation, low interest rates, and economic uncertainty make holding cash riskier than it seems. In this video, we're going to look at 5 assets that are safer than cash, especially for folks thinking about retirement, preserving wealth, or just sleeping better at night. Let's start with something simple, powerful, and almost completely ignored by the average saver: I bonds. These are U.S. government savings bonds designed to do one thing really well: protect your money from inflation. Most high-yield savings accounts today offer 4 to 5% interest before taxes. But when inflation rises, that rate usually doesn't budge fast enough. I bonds, on the other hand, pay interest based on 2 components: a fixed rate, currently 1.3% as of early 2025, an inflation-adjusted rate which changes every 6 months based on the CPI, Consumer Price Index. When inflation spiked in 2022 to 2023, I bonds paid over 9% annually. That's not a typo, 9% risk-free. I bonds are issued and backed by the U.S. Treasury, the same people who pay Social Security and run the IRS. Unless the U.S. government defaults, and if that happens, we've got bigger problems. Your I bonds are as safe as it gets. They don't lose value. The worst-case scenario? The inflation rate drops to 0 and you just earn the fixed rate, but you won't lose money. There are a few rules to know. You can only buy up to $10,000 per person per year online. You can buy another $5,000 with your tax refund. You have to hold them for at least 1 year. If you cash them in before 5 years, you lose the last 3 months of interest. That's it. No fees, no market volatility, no third-party risk. If you're in your 50s or 60s, you're not looking to double your money overnight. You're looking to protect your savings, beat inflation, and avoid chaos. You can buy I bonds through the Treasury Direct website. It's a bit old school in design, but once you're in, it's straightforward. Pro tip: if you're married, each of you can buy $10,000 per year. That's $20,000 annually, inflation protected, with 0 market risk. And if you're filing taxes, consider using part of your refund to grab another $5,000. All right, that's I bonds. Safe, smart, and surprisingly effective in today's climate. Let's move to another asset that's just as safe, but even more flexible. Short-term Treasury bills. T-bills are short-term loans to the U.S. government. You lend Uncle Sam your money, and he pays you back with interest. The terms are short, usually 4, 8, 13, 26, or 52 weeks. That means your money isn't locked up for years, just a few months. Here's the deal. Many savings accounts today offer 4% interest, but they can change that rate anytime. With T-bills, when you lock in a 6-month or 1-year rate, you're guaranteed that return. No surprises, no games. And like I bonds, these are also backed by the U.S. government. That means 0 credit risk. The government will pay you back. T-bills don't pay interest the way a savings account does. Instead, you buy them at a discount. And when they mature, you get the full amount. For example, you might pay $970 today for a $1,000 T-bill. In 6 months, you get the full $1,000. Since that $30 difference, that's your earnings. One big bonus: the interest you earn is exempt from state and local taxes. If you live in a high-tax state like California or New York, that's a meaningful boost to your real return, something regular savings accounts can't offer. T-bills are ideal if you want better returns than a bank. You don't want to take market risk, and you want your money back in a few months. Retirees often use T-bills as a cash alternative, a place to park emergency funds or short-term savings that aren't earning enough in a regular account. You can buy T-bills straight from the government at treasurydirect.gov, or more easily through most brokerages like Schwab, Fidelity, or Vanguard. In fact, many brokerages now offer T-bill ladders, which automatically reinvest maturing bills into new ones, giving you a steady stream of safe returns while keeping your cash working. So far, we've covered 2 ultra-safe government-backed options: I bonds and T-bills. But what if you want something more tangible? Something that not only protects value, but generates income month after month. Let's talk about conservative rental real estate. So far, we've looked at assets that are government-backed, liquid, and low risk. But what if you want your money to do a bit more? Not just protect value, but actually generate consistent income that grows with inflation? That brings us to conservative rental real estate. Now, before you roll your eyes and think, I don't want to be a landlord, stick with me. Because there's a way to approach real estate that's stable, scalable, and surprisingly hands-off. Real estate isn't just about appreciation. It's about cash flow and inflation protection. When prices go up, rents usually go up too. So, while inflation eats away at the value of your dollar, a well-placed rental property can adjust in real time. That makes it one of the few assets where inflation actually works in your favor. We're not talking about flipping homes or buying luxury condos in hot markets. Conservative real estate means cash flow positive properties from day one. Modest, stable neighborhoods, not high-risk boom areas. Minimal or no mortgage. Ideally, properties you own outright or finance very lightly. Long-term tenants who stay put and treat the place like their own. The goal isn't to get rich. The goal is steady, predictable income. Let's run the numbers. Say you buy a $200,000 duplex and rent each side for $1,000 a month. That's $2,000 in gross monthly income. Subtract insurance, taxes, and maintenance, maybe $600 to $700 per month. And you're still clearing around $1,200 monthly or around $14,000 a year. That's a 7% yield, with room for rent increases over time. Try finding that in a savings account. But I don't want to be a landlord. Totally fair. Most people don't. That's why property managers exist. For 8 to 10% of your rent, a property manager can find and screen tenants, handle repairs, collect rent, even coordinate legal issues. You collect the net income and they handle the headaches. If you choose the right person, it's truly passive. If you're considering this, here's what to prioritize. Locations with steady job markets, not boom and bust towns. Modest homes like 2 to 3 bedrooms, low maintenance, safe area. Properties near you or in states with landlord-friendly laws. Units that don't need major renovations, you want plug and play. And most important, only buy if the numbers make sense from day one. No speculation, no gambling on appreciation. Not ready to buy a new property? Look into accessory dwelling units, also called ADUs, or renting out a portion of your existing home. Many retirees generate solid income just by converting a basement or garage into a small rental. It's cheaper than buying another property, and the returns can be just as strong. This option is best for folks who have some extra capital to invest. Want stable income, not just growth? Prefer tangible assets they can see and control. Real estate isn't for everyone, but when done conservatively, it can be a durable hedge against inflation and a powerful source of peace of mind income. All right, that's rental real estate done the safe way. Next, let's look at an asset that's been trusted for centuries, doesn't rely on anyone's promises, and shines brightest during economic storms: physical gold. Let's shift gears from rental property to something even more old school. And I mean really old. We're talking about physical gold, not ETFs, not paper gold, not certificates. We're talking about actual bullion. Coins or bars you can hold in your hand, store in a safe, and pass on to the next generation. Gold isn't sexy. It doesn't pay interest. But it has one job, and it does it well. It holds value when everything else feels like it's falling apart. Gold has been used as a store of value for thousands of years. Empires have come and gone, currencies have failed, markets have crashed, but gold, it's still around, and it's still trusted. In times of war, inflation, banking crises, and currency devaluation, people turn to gold. Why? Because it's nobody's liability. It's not a promise. It's not a contract. It just is. Gold tends to shine when other assets are struggling. In 2008, while stocks dropped over 50%, gold went up. In 2020, when markets panicked during COVID, gold surged. In 2022, when inflation spiked, gold held steady while tech stocks tanked. It's not about massive gains, it's about stability when everything else is shaking. If you're going to own gold, own it directly. That means physical bullion, not paper substitutes that can get frozen, restricted, or manipulated. The best options are 1-ounce government-minted coins, like American Eagles, Canadian Maple Leafs, Krugerrands. Gold bars from reputable refiners like Pamp Suisse or Perth Mint. Store it in a home safe, a safe deposit box, or even a professional depository. Most financial planners who recommend gold suggest keeping 5 to 10% of your portfolio in precious metals. It's not meant to replace stocks or bonds. It's a hedge, a form of insurance. If you never need it, great. But if inflation runs hot or the dollar weakens, you'll be glad you had it. Silver can be a decent alternative. It's more affordable and historically follows gold's price movements. The downside, it's more volatile and bulkier to store. Other metals like platinum and palladium are more speculative. For most people, gold is the reliable choice. One important tip: don't buy collectible or rare coins from late-night TV or high-pressure dealers. Stick with bullion coins with low premiums. You're paying for the metal, not the marketing. A good rule of thumb: if the coin costs 20% more than the market price of gold, you're overpaying. Gold is for people who want peace of mind. It doesn't generate income, and it won't explode in value. But it will sit quietly, doing its job of protecting your wealth while the world around it changes. If you're retired or nearing retirement, gold offers something that's hard to find today: stability you can see and touch. All right, we've covered government bonds, real estate, and now gold. But there's one more asset that's not only safer than cash over time, it actually pays you to own it. Let's finish strong with high-quality dividend-paying stocks. So far, we've talked about safe assets that defend your money. But let's talk about an option that can also grow your money steadily without taking on wild risks. I'm talking about high-quality dividend-paying stocks. The kind of companies that have been paying you every quarter through recessions, pandemics, and market crashes. When you own a dividend stock, you're not just betting on the price going up. You're actually getting paid a slice of the company's profits on a regular basis, usually every 3 months. That's called a dividend, and it shows up as cold, hard cash in your brokerage account. Now, stocks aren't technically safe in the short term. Prices move. But when you stick with blue-chip companies that have been around for decades and never cut their dividends, you get something that feels a lot more stable. These companies don't swing wildly like tech startups. They're consistent performers in sectors like healthcare, food, consumer goods, and utilities. There's a group of elite companies called the Dividend Aristocrats. These are firms that have increased their dividend payouts every single year for at least 25 years. That includes Johnson & Johnson, Procter & Gamble, Coca-Cola, McDonald's. Through recessions, rate hikes, and inflation, they just keep paying and keep raising their payouts. If you're in or near retirement, dividend stocks can provide income you don't have to touch your principal to get. Let's say you invest $100,000 across dividend stocks that yield 3 to 4%. That's $3,000 to $4,000 a year in cash without selling a single share. And unlike bonds, that income can grow over time as companies raise their dividends to keep up with inflation. Here's how to do this wisely. Look for companies with a 30-plus year track record of paying and raising dividends. Avoid yields that are too high. They may not be sustainable. Consider dividend-focused ETFs like VIG or SCHD for instant diversification. Reinvest dividends if you don't need the income yet. It's like compound interest on steroids. And most importantly, think long-term. Dividend investing rewards patience, not prediction. Dividend stocks are great if you want income that keeps growing, don't want to sell assets just to pay bills, are okay with a little price fluctuation in exchange for steady cash. They won't shield you from short-term market dips, but over the long haul, they tend to outperform cash and even many bonds. With the right approach, they offer income, growth, and resilience in one package. Let's put it all together. You've now got a toolkit of 5 assets that can protect your wealth better than cash ever could. All right, let's recap the 5 assets that are safer than holding cash in today's economy. U.S. Treasury I Bonds, inflation-protected and backed by the government. Short-term Treasury bills, higher yields than savings accounts, minimal risk. Conservative rental real estate, steady income, inflation-resistant, tangible. Physical gold, crisis-proof, no counterparty risk, long-term store of value. High-quality dividend stocks, reliable income with growth and inflation protection. These aren't flashy bets. They're smart, steady, proven strategies to keep your money safe and working, especially if you're thinking about retirement, protecting your nest egg, or just tired of watching your cash lose value. If you found this helpful, give the video a thumbs up. It really helps more people see it. Subscribe for more simple, smart investing tips for people who actually care about keeping their money safe. And drop a comment below. Which of these 5 assets feels right for you right now? I read every comment, and I'd love to hear your thoughts or questions. Thanks for watching. Stay smart, stay safe, and I'll see you in the next one.